banks are quietly preparing for a massive liquidity crisis. Imagine waking up one morning to find that your bank has frozen withdrawals. ATMs don't work. The apps show errors. And no one knows when things will be fixed. This might sound like a doomsday scenario, but behind closed doors, global banks are quietly preparing for just such a liquidity crisis. While the headlines are filled with inflation stats, elections, and geopolitical tension, the world's biggest financial institutions are running stress tests, stockpiling reserves, and revising emergency liquidity protocols. Why? Because they see what's coming, and they're not telling the public. From the hidden risks in the repo markets to the mounting pressures in commercial real estate and private credit, the financial plumbing that keeps our money flowing is cracking beneath the surface. And while central banks appear calm, insiders are already bracing for a silent storm. In today's episode of Money Minded, we uncover the silent preparations happening inside the world's biggest banks, the signals pointing to a looming liquidity freeze, and what it could mean for everyday people like you. If 2008 was a credit crisis, what's coming could be worse, a liquidity collapse where money exists only on paper. Stay with us. Chapter 1. The calm before the crisis, hidden signs in the global banking system. On the surface, everything looks fine. Stock markets are climbing, inflation is reportedly under control, and big banks continue to post impressive quarterly earnings. Central banks issue statements reinforcing their commitment to financial stability, while regulators assure the public that the banking system is well capitalized and resilient. But beneath the headlines, something much more troubling is brewing. The global financial system is quietly approaching a moment of extreme stress. Banks, central banks, and financial institutions are making silent moves, preparing for a scenario no one wants to talk about, a full-blown liquidity crisis. So what are the signs? And why isn't anyone sounding the alarm? Let's start with the repo markets, the short-term lending engine that powers day-to-day liquidity in the financial world. When banks need overnight cash, they lend and borrow using high-quality collateral like government bonds. But recently, repo markets have shown unusual stress. In 2023, repo rates spiked without warning. Banks began hoarding collateral, and some institutions even refused to lend at all. This signals a critical breakdown in trust. Why is this important? Because the repo market is where banks go when they need emergency cash. If that market seizes up, liquidity vanishes instantly. At the same time, central banks have been quietly introducing new emergency lending facilities. After the failures of regional U.S. banks like Silicon Valley Bank and First Republic in 2023, the Federal Reserve launched the Bank Term Funding Program, BTFP. This program allowed banks to trade their devalued bonds for full face value cash, avoiding mark-to-market losses. In effect, it was a stealth bailout. But here's the catch, more than 100 institutions signed up for this facility, including some of the largest banks in America. That's not a sign of strength, it's a sign of widespread fragility. Next, take a look at how liquidity coverage ratios are being reported. The LCR is a critical metric that tells us whether a bank has enough liquid assets to survive 30 days of severe stress. On paper, many banks show LCRs above the 100% threshold. But dig deeper and you'll find that much of this liquidity is tied up in long-duration government bonds, which have dropped sharply in value due to rising interest rates. In other words, many banks appear liquid on paper, but their high-quality liquid assets would take major losses if sold today. That's not real liquidity. That's accounting magic. Behind closed doors, Large institutions are hoarding cash and central bank reserves. Lending activity has slowed. Commercial loan growth is down. Some banks are quietly tightening credit standards, not because of credit risk, but because of liquidity concerns. They want to keep as much ready capital on hand as possible. This pattern is disturbingly familiar. In the months leading up to the 2008 financial crisis, banks engaged in the exact same behavior. They withdrew from interbank lending, increased their reserve buffers, and became increasingly conservative in deploying capital. These moves, while rational for individual institutions, collectively drained the system of liquidity, and when Lehman Brothers collapsed, the entire credit system froze. It's happening again, but slower, and more silently. Another warning sign? Commercial real estate exposure. Banks, particularly regional ones, are heavily exposed to office buildings and retail space, assets that have declined sharply in value post-COVID. Defaults are rising. Vacancy rates are growing, and refinancing is becoming more difficult as interest rates remain elevated. These unrealized losses remain buried in bank balance sheets, threatening future liquidity if forced sales occur. Yet public messaging remains calm. Regulators avoid using the term crisis, knowing full well that confidence is the oxygen of modern banking. If depositors and investors sense fear, they will pull capital quickly. That's why the strategy is to reassure in public, while bracing in private. Make no mistake, this is a liquidity time bomb. And the banks know it. They are quietly strengthening emergency funding lines, testing internal liquidity stress scenarios, and building contingency plans for sudden market dislocations. It's all happening in the background, hidden from the public eye but clearly visible to those who know where to look. In the next chapters, we'll examine how this brewing crisis could unfold. Who is most vulnerable, and what could push the system over the edge? Because in a liquidity crisis, panic spreads faster than policy. Chapter 2. How the crisis could start, the dominoes lined up. Financial crises rarely begin with fireworks. They begin with whispers. Small cracks. A missed payment here, a liquidity shortfall there. But once the first domino falls, the rest can come down fast, and violently. So how exactly could the next liquidity crisis ignite? The groundwork has already been laid. Let's break down the key fault lines that could trigger a chain reaction across the global banking system. 1. Commercial real estate defaults. One of the biggest and most underreported risks today lies in commercial real estate, CRE. Office buildings in major cities are sitting half empty. Their values collapsing as remote work becomes permanent. According to Moody's, office vacancy rates in the US reached 20% in 2024, the highest on record. Thousands of CRE loans are coming due in the next 12 to 18 months, and many will not be able to refinance at current interest rates. The result? Defaults. Who holds those loans? Mostly regional and mid-sized banks. If defaults spike, these banks will be forced to either recognize massive losses or scramble for emergency liquidity. Either way, it sets off stress across the sector. 2. Private credit and shadow banking exposure. In recent years, traditional banks have shifted risk off their books by leaning on non-bank lenders, aka the shadow banking system. These include hedge funds, private equity firms, and credit funds offering corporate loans without regulatory oversight. But these firms are now facing margin calls and redemption pressures as liquidity tightens. If a major player defaults or suspends withdrawals, contagion could spread rapidly to traditional banks who are indirectly exposed via credit lines, derivative contracts, or shared asset holdings. The 2008 crisis taught us that off-balance sheet risk is just as dangerous as what's visible. The same dynamic is quietly building again, only this time, it's even more opaque. 3. A sudden bank run, triggered by digital speed. The collapse of Silicon Valley Bank, SVB, in 2023 was a wake-up call. It showed how fast a modern bank run can happen. In less than 48 hours, depositors pulled over $40 billion using mobile apps and instant transfers. There were no lines outside branches. No time to intervene. Now imagine that happening at a larger institution. A rumor on social media, a downgrade from a ratings agency, or a delayed payment, anything could trigger panic. And once trust evaporates, it's game over. In a hyper-connected world, confidence can collapse in real time, and with it, liquidity. Foreign exchange shock or sovereign debt crisis. Banks are also deeply exposed to government bonds and foreign currency assets. In emerging markets, a sharp devaluation of the local currency or a sovereign default could ripple through global balance sheets. Take Turkey or Argentina, for instance, both teetering under debt burdens. A sudden blowout in sovereign spreads could cause banks to mark down their holdings, impair collateral, and trigger margin calls across global markets. This is especially dangerous because many international banks are intertwined through currency swaps, offshore lending, and derivatives. A crisis in one region can quickly become global. 5. Central bank policy error. Central banks are walking a tightrope. Keep interest rates too high, and they crush borrowing, liquidity, and asset values. Cut rates too fast, and they risk reigniting inflation. But the real danger lies in being too slow to respond. In a fast-moving liquidity freeze, every hour counts. Delays in opening emergency lending windows, miscommunication, or hesitation to guarantee deposits could allow panic to spread unchecked. Remember, in 2008, it wasn't just bad loans that triggered collapse, it was the slow, fragmented response that allowed fear to metastasize. The same risk exists today. So, what happens next? Once the first trigger hits, whether it's a CRE default wave, a shadow bank collapse, or a sudden bank run, the response of the broader system becomes critical. Banks will rush to call in loans, sell liquid assets, and pull back from lending. This amplifies stress in the system. Businesses will find it harder to access short-term credit. Consumers will see frozen accounts or withdrawal limits. And financial markets could seize up, as trust between institutions disappears. This isn't hypothetical, it's how liquidity crises unfold. And this time, the digital speed of money makes it even harder to control once it starts. In the next chapter, we'll dive into the specific vulnerabilities of the global banking system, and how key institutions may fare when the liquidity dries up. Stay with us, because understanding where the cracks are is the first step to protecting yourself before the storm hits. Chapter 3, Where the Cracks Are, Which Banks Are Most Vulnerable. As the threat of a global liquidity crisis grows, the next logical question becomes, which banks are most at risk? Not all financial institutions are equally exposed. Some have built strong balance sheets and conservative lending practices. Others? They're walking a tightrope. To understand where the vulnerabilities lie, we have to look deeper than the headlines. Behind every balance sheet is a story, one that reveals how certain banks could be caught off guard when liquidity vanishes. 1. Regional and mid-sized banks, too many eggs in one basket. Let's begin with regional and mid-sized banks, especially in the United States and parts of Europe. these institutions often lack the diversified revenue streams of global giants. Instead, they are heavily concentrated in commercial real estate loans, local business lending, and municipal debt. This makes them highly sensitive to interest rate shocks and localized downturns. The failure of Silicon Valley Bank, Signature Bank, and First Republic Bank in 2023 wasn't an anomaly, it was a glimpse into the structural weakness of banks that bet too heavily on low-rate environments. These banks bought long-duration bonds and loans when rates were near zero. When the Federal Reserve began hiking aggressively, the value of those assets plummeted. To make things worse, these banks tend to have a less diversified depositor base. Many rely on uninsured deposits from tech firms, real estate developers, or small businesses. These depositors are quick to move when trouble arises. As we saw with SVB, a concentrated, panicked client base can trigger a bank run in a matter of hours. 2. European banks, exposed to fragile sovereigns and energy shocks. In Europe, many banks are carrying the weight of sovereign debt exposure from fragile economies like Italy, Greece, and Eastern Europe. As public debt levels rise and political tensions mount, even small shifts in bond yields can cause enormous mark-to-market losses for these institutions. Moreover, European banks remain deeply tied to energy markets. After the 2022 energy crisis and Russian gas cutoffs, many financial institutions in Germany, Austria, and France faced liquidity pressures due to margin calls and derivatives exposure linked to energy futures. While ECB liquidity injections papered over these risks, they haven't disappeared, they've simply been deferred. 3. Global systemically important banks, GSIBs, too big to fail, or too interconnected to save. The largest banks in the world, think JP Morgan Chase, HSBC, Deutsche Bank, BNP Paribas, are known as GSIBs, global systemically important banks. These institutions have vast global footprints, trading desks, and derivative exposures that span dozens of countries. On the surface, they appear well capitalized and liquid. But their weakness lies in interconnectedness. If a major counterparty defaults, say, a hedge fund or a sovereign borrower, these banks can face cascading losses via swap contracts, repo agreements, and structured credit products. It's not about whether they'll collapse outright, it's about whether they can function normally if market liquidity freezes. In 2008, Lehman Brothers didn't fail because it ran out of capital. It failed because no one wanted to do business with it anymore. The same risk applies to GSIBs in a crisis scenario. Once confidence evaporates, so does market access. 4. Banks heavily dependent on shadow funding and derivatives. Another red flag, banks that rely on short-term wholesale funding from non-bank lenders, such as money market funds or hedge funds. These funding lines can dry up in a panic. Additionally, banks deeply involved in complex derivative markets, especially interest rate swaps and credit default swaps, could face liquidity black holes if market volatility spikes. These instruments require margin collateral, which must be posted in real time. If asset prices drop and volatility rises, margin calls could force banks to sell off assets into falling markets, amplifying losses. This exact dynamic occurred during the 2020 COVID market crash and was only prevented by massive intervention from central banks. 5. Emerging market banks, vulnerable to currency and capital flight. Finally, emerging market banks, especially in countries with high external debt and low FX reserves, are extremely vulnerable to a liquidity shock. If the US dollar strengthens rapidly or global investors flee risk assets, these banks face a double blow: rising borrowing costs and declining foreign currency inflows. Many rely on US dollar funding to maintain local lending operations. If that pipeline shuts down, local economies could seize up, and domestic banks could fail even without major internal issues. Turkey, South Africa, Egypt, and Pakistan are examples where this risk is very real. Summary: the cracks are already visible. While no one can predict the exact trigger or timeline of a liquidity crisis, the fault lines are clear. Overexposure to long-term bonds, reliance on fragile deposits, shadow banking entanglements, sovereign debt risks, and the illusion of liquidity in thinly traded assets. The global banking system today is more complex and interconnected than ever before. And in complexity, fragility hides. In the next chapter, we'll explore how central banks are quietly coordinating behind the scenes, and whether their tools will be enough to prevent a liquidity meltdown once the panic begins. Chapter 4. The Central Bank Playbook: What they'll try when liquidity vanishes. When the financial system faces a liquidity crisis, all eyes turn to one institution, the central bank. Whether it's the Federal Reserve, the European Central Bank, or the People's Bank of China, these institutions serve as the lender of last resort, the fire department of the global financial system. But here's the uncomfortable truth: the playbook they rely on is old, and it may no longer be enough. Let's walk through the tools central banks are likely to deploy when the next crisis hits, and why this time, they might not work as intended. 1. Liquidity injections through emergency lending facilities. The first move is predictable: create or revive short-term emergency lending tools. In the US, this could mean reactivating or expanding programs like the discount window, where banks can borrow overnight against collateral; the Bank Term Funding Program, BTFP, allowing banks to borrow at par value against depreciated assets; commercial paper F, funding facilities, to keep short-term corporate credit markets alive. These programs aim to pump immediate cash into the system and reassure markets that no solvent bank will be allowed to fail due to a temporary liquidity crunch. But here's the problem: in the modern digital banking world, liquidity needs are instantaneous. Panic withdrawals happen in seconds, not days. Unless central banks can inject cash faster than the speed of a tweet, these tools risk being too slow. 2. Quantitative easing, the return of the balance sheet bazooka. If panic persists, central banks may reach for their most powerful modern weapon, quantitative easing, QE. QE involves buying long-term government bonds and mortgage-backed securities to inject liquidity directly into the financial system. This tool was used aggressively during the 2008 crisis and again during COVID-19. But the QE environment has changed. Back then, inflation was low. Today, inflation is sticky and politically sensitive. Restarting QE too quickly could cause a sharp drop in bond yields, devalue currencies, and reignite inflation, especially in import-dependent economies. Moreover, QE disproportionately benefits asset holders, which could trigger backlash in an already unstable political climate. It may stabilize markets, but it could also worsen inequality and public distrust. 3. Coordinated global action, the central bank swap lines. Another major move will be global coordination. During periods of global stress, the Federal Reserve often activates swap lines with major central banks, such as the ECB, Bank of Japan, and Bank of England. These swap lines allow foreign banks to access US dollar liquidity, crucial in a world where most trade, debt, and banking still revolves around the dollar. In March 2023, After the Credit Suisse crisis and US bank failures, the Fed expanded daily dollar swap operations, a sign that stress was already building beneath the surface. In a full-blown crisis, we can expect these swap lines to expand dramatically. But here's the hidden danger: not all countries have access. Emerging markets without strong bilateral ties could be left out, triggering localized crises that spill over globally. For forward guidance and market reassurance, the verbal toolkit. Don't underestimate the power of words. One of the central bank's most subtle tools is forward guidance, statements meant to calm markets and shape expectations. Think back to Mario Draghi's famous line in 2012, "Whatever it takes." Those 3 words likely saved the euro from collapse. Expect central bankers to issue strong, coordinated statements emphasizing system stability, their commitment to intervene, and the adequacy of banking capital. But in a hyper-fragmented, digitally connected world, words may no longer be enough. Trust can erode far faster than it can be rebuilt. And one bad communication, or silence, can spark the very panic they hope to prevent. 5. Regulatory forbearance and temporary rule changes. In a liquidity crunch, regulators may quietly allow banks to bend the rules. This can include allowing banks to count impaired assets as liquid, temporarily suspending capital requirements, like Basel III buffers, guaranteeing uninsured deposits, as happened after SVB's collapse, extending deadlines for mark-to-market accounting. These measures are designed to buy time, giving banks breathing room to manage losses without sparking immediate panic. But the longer the forbearance lasts, the more fragile the system becomes. Eventually, reality catches up. And if regulators are seen as hiding losses, public trust can collapse just as quickly as bank reserves. Why it might not be enough this time? Here's the bottom line: central banks are preparing. They've rehearsed these crisis tools since 2008. But this time, the environment is radically different. Inflation is still a threat, limiting how aggressively they can act. Debt levels are far higher, meaning every new dollar of liquidity creates long-term instability. Markets move faster, making delayed responses lethal. And confidence is weaker, with trust in institutions at historic lows. In the next crisis, the issue may not be whether central banks act, it's whether anyone believes they still can control the outcome. In the final chapter, we'll explore what happens if the system breaks anyway, and what individuals, businesses, and governments can do to prepare for a post-liquidity world. Conclusion: when liquidity dies, what happens to the real economy? Liquidity is the lifeblood of the global financial system. It's invisible when it flows, but when it stops, the entire body convulses. And make no mistake, when banks run out of liquidity, it doesn't stay confined to Wall Street or the City of London. It hits the real world fast. Let's talk about what happens next. 1. Credit freezes, businesses can't borrow, consumers can't spend. In a liquidity crisis, banks stop lending. Period. It doesn't matter if you have good credit. It doesn't matter if your business is profitable. When banks are uncertain about their own survival, they pull back from everyone. Credit lines are cancelled. Mortgages delayed. Business loans postponed or denied. This has a cascading effect on the real economy. Small and mid-sized businesses can't meet payroll. Homebuyers are locked out of mortgages. Consumers cut spending out of fear and necessity. This creates a downward spiral. Falling demand leads to layoffs, which leads to even less spending, which leads to recession, or worse. 2. Asset price collapse, the everything bubble pops. With no liquidity in the system, financial markets seize up. Forced selling begins. And because many institutions use leverage, borrowing to invest, margin calls multiply losses quickly. We've seen this before. In 2008, it was housing and mortgage-backed securities. In 2020, it was corporate bonds and ETFs. In the next crisis, it could be everything at once. Stocks, bonds, real estate, and even safe havens like gold or Bitcoin could experience sudden, synchronized drawdowns, not necessarily because their fundamentals are broken, but because everyone needs cash, fast. The result? Wealth destruction on a massive scale. For retirees, for pension funds, for nations. 3. Trust breaks, social and political fallout begins. But the biggest casualty of a liquidity crisis is trust. When people see bank accounts frozen, withdrawals limited, businesses collapsing despite doing everything right, they start to question the system itself. That's when social unrest grows. That's when governments panic. That's when radical ideas gain traction, whether it's universal basic income, capital controls, or a total rejection of fiat currencies. A liquidity crisis is never just economic. It is deeply political and psychological. It can redefine generations. 4. What can you do? Prepare like institutions are preparing. Let's be clear. If banks are quietly preparing for a liquidity crisis, you should be too. Here's what smart investors, families, and businesses are doing. Building emergency cash reserves. Not just assets. Diversifying exposures beyond one bank or country. Reducing debt levels, especially variable rate debt. Holding liquid alternatives, assets that can be accessed quickly. Monitoring counterparty risk, knowing where your money really sits. This isn't fear-mongering. It's realism. The system isn't broken yet, but it's under pressure. And the more complex, indebted, and fast-moving it becomes, the more fragile it gets. Final thought, stay informed. Stay ahead. You don't need to panic. You need to understand. Because in every crisis, those who are prepared, not panicked, come out stronger. If you're watching this video, you're already ahead of the curve. The question is, what will you do next? Stay with us on Money Minded as we continue to decode the signals, trends, and underreported risks shaping the global financial future. If you found this video helpful, don't forget to like, subscribe, and share it with others who need to be prepared. Thanks for watching. This is Money Minded, helping you navigate the calm before the financial storm.